What if you had instant analytics on your PDP images and a faster way to create content that performs better? That's what we're diving into in today's episode, how top brands and retailers are using analytics and automation to stay ahead across retail media and the digital shelf. It's Rapid helps teams scale smarter. They analyze image performance, they help you create optimized assets for retail media networks and the digital shelf, and they integrate directly with PIM and DAM systems for seamless execution. Brands like Pepsi, Mondelez, and Instacart use its Rapid to go beyond basic tools to uncover gaps in PDP and retail media performance by analyzing the images themselves, not just the count. Streamline banner creation across hundreds of formats for Amazon Ads, Walmart Connect, and other retail and social platforms, and launch high-performing content more than 80% faster across e-commerce and marketing channels. If you're buried in manual work or struggling to keep up, this episode and It's Rapid will show you a better way. Visit itsrapid.ai to learn more.
Welcome to Beyond the Shelf with Dave Feinlieb. This show is an open exploration of the people and process behind e-commerce. Through conversations with innovators in the space, we learn the stories of these leaders and their strategies for e-commerce success. We publish new episodes every Tuesday morning, so be sure to subscribe wherever you get your podcasts. And now, here's your host, Dave Feinlieb. Dave's guest this week is Ben Narasin. Ben is a venture capitalist and entrepreneur, and the founder and general partner of Tenacity Venture Capital. He invests at the intersection of technology, commerce, and consumer behavior, with a long track record of backing companies that shape how brands sell, market, and operate in a digital-first world. Before launching Tenacity, Ben was an early operator and investor in e-commerce, marketing technology, and SaaS businesses. Today, he works closely with founders and leadership teams, helping them navigate growth, scale, and rapid technological change. They'll talk about how Ben got his start in e-commerce and venture capital, how the VC lens on commerce has evolved, and where he sees AI, especially generative and agentic systems, creating real leverage across the e-commerce stack, as well as what founders should be thinking about as the pace of change accelerates. Please enjoy Dave's conversation with Ben Narasin.
Ben, welcome to the show.
Thanks for having me.
Tell us about you. Take us back. How'd you get your start in investing and entrepreneurship and all that?
Sure. So it all started when I was, 11 maybe. Actually, I had some entrepreneurial journeys before that, like selling stickers in school. But I got my first job when I was 11, working for 25 cents an hour in credit in a bookstore so I could make a bigger comic book collection. Then I started my first company when I was 12 as a comic book dealer going to Comic-Con. Anyway, I spent about 25 years being an entrepreneur all through high school and college. Really have never had any interest in life other than entrepreneurship and my family or the effort to get to having a family. So final piece of the journey on being an entrepreneur was I started one of the first .coms in 1993. Supposedly we invented cost per click in 94.
That's awesome.
Took that company public in 99, took it private in 2001, moved west during that process, got here, California about 22 years ago, and saw this very large gap in the market between sort of angel investing and venture investing, which is now called seed, but back then didn't really exist. So I started one of the first two institutional seed funds in the world around 2007, had a great run. Lending Club went public as the largest tech IPO of the decade. Zenefits raised in an equivalent value as the fastest growing SaaS company of all time. That company didn't work out in the end, but Rippling has done very well. And I invested in both. And got to know about 300 tier one VCs. So after about 8 years as a seed investor, a lot of those VCs came to call to potentially have me move over from seed to ABC. And so I did traditional venture capital for about 7 years, mainly at NEA, New Enterprise Associates. It's the largest venture firm in the world historically. Phenomenal group of people, really love them. And at one point, we discontinued the seed practice. Now, I didn't go to NEA just to do seed. I did Series C investing, et cetera, et cetera. But what I learned there was that I really love seed. I mean, I can make good money doing late stage. In fact, per their documents, I delivered a 97% IRR on my late stage investing. But I just didn't enjoy it. So you can make a lot of money, but it's not what I enjoy. So I wanted to do seed, and I suggested we do a seed fund, and they suggested that I was good at this and that they would be happy to help me spin out and be my first check. So raised Tenacity Fund 1 between basically the last couple of months of 2021. Just completed investing in Tenacity Fund 1, and I'm now starting to invest out of Tenacity Fund 2, where I do seed, very occasionally pre-seed, tech of all sorts, except crypto, security, and med tech. And lastly, I write sort of $1 to $3 million checks, prefer to lead, prefer to price rounds, and I'm actively involved in helping my entrepreneurs if they want me to be.
I love it. What a great history. Will you give us, just for our listeners who may not be versed in seed, pre-seed, ABC, and all that, VC 101, everyone's heard of venture capital, but the quick rundown.
Yeah, a long journey for me, because when I moved here, I had never taken venture capital. I'd maybe met 2 VCs. I didn't really understand it at all. But I basically got a triple PhD in that 8 years of research to get to know these 300 plus VCs that I spent a lot of time interviewing and just trying to understand better. So if you think about venture capital, first of all, this is one of the many forms of private equity. In essence, it's LP-GP structure. LPs, limited partners, people with capital, whether those are institutional, high net worths, foundations, invest in general partners, people like me, to go out and invest that money pretty much on their behalf. And then we share in the upside. We get fee and carry. Bottom line, the real money is made by getting a piece of the action. You sometimes hear politicians yapping about carried interest. Carried interest is that if I invest both my money and my LP's money, and I have a 10% stake in my own fund, which is about 8x the norm, I put money into a company today, help that company, 10 years from now it exits, I get rewarded for the profit on the stock, and I get treated as if it's capital gains, which I believe is infinitely fair, but we're not having a political discussion. So venture funds have different types of focuses. There are the traditional old school world of venture capital was funds that looked for enormous opportunities right at the beginning when they needed first institutional capital. And that used to be called Series A. Apple, HP, any of these. So many companies, Cisco, just on and on and on. Like something like a quarter of the jobs in the United States are from venture-backed companies. Well, over time, venture funds got bigger and bigger. If you go back to sort of the 90s, venture funds were hundreds of millions of dollars at most. But before the bubble, after the bubble, there were many billions of dollars. This is where the opportunity was created, because venture firms don't grow by hiring people. It takes forever to hire or to get hired in venture capital. And so instead, when they had bigger funds, they had to write bigger checks. So Series A checks got bigger. Today, here's how I think about the world. Pre-seed is what I was doing in 2007, which used to be called seed. Smart people with an idea, PowerPoint slides, no product. I need some money to build this and prove that it can work. Seed today is what Series A was for years. I've built this thing. I have some early customers. I need money to grow. Series A today is what Series B used to be, which is the company's growing really well. Now we need more money to grow even bigger. And then on and on and on. And so A, B, C, D is just the letters indicating the rounds, the investments after the first one by a large institution. So, I don't know, pre-seed is your middle school, seed is your elite high school, Series A is college, B, C, D is PhD and everything else in the land of fundraising. But I will tell you that I try to only work with tier one firms. There's not very many tier one seed funds. I think you can count them on one hand, to be honest. But for anybody at that level, any venture investment needs to have a shot at being a future public company of size and substance. And one of the things people don't understand. So, the old saying about the bank robber, why'd you rob banks? And he said, that's where the money is.
Yeah.
Yeah. Well, people go to VCs because there's money there. But the reality is, I fund roughly 1 out of 1,000 pitches I see. The opportunity to find a company that can go on, if it works, to be as huge as I need it to be is a tiny, tiny, tiny little window. And the flip side of that is companies will fail and you'll lose all your money. That's the risk you take. You can take the risk of losing all your money if the ones that work can make you 40, 50, 100 plus X on your investment. And that is the very nature of the risk that venture capital is willing to take.
All right, let's talk about the 1 in 1,000. What are you looking for?
So I have lots of pithy little sayings. This will be repetitive for people who've seen me speak. 5 things. People, great idea, huge market if it works. The other thing I've learned is that I look for entrepreneurs that make me say, wow. I mean, in 2023 and 2024, I saw 10,000 pitches. I funded 6, less than 1 in 1,000 in total. But the real numbers were 2023, I saw 8,000. A lot of online demo days. I funded 3, a lot less than 1 BIP, 1 basis point. 2024, I got back on the road, just did the hard work, just got out there, traveled, met people, saw the people I know in my network. And once again, funded 3 companies, but on a base of 2,000 this time. So 1.5 basis points instead of less than 1. What I learned is out of those 10,000 pitches, I had second meetings with maybe 4 or 5 dozen companies. If I don't say wow in the very first meeting, there's no continuation. And I'm very straightforward. I can't take that many meetings and have people following up on me. So I always tell them in the meeting, if it's not a fit, try to be helpful within the time allowed. And then that's that.
Yeah.
So, look, I think if you're an entrepreneur and you've dedicated your life to this and taken great financial risk, you deserve the respect and time that people like me should give you. But if it's not a fit, the limit is to the time we booked. And then, I really hope you can do well. And if there's something I promised to do, then I'm going to do it. But it's just very, very hard to find those future opportunities. And even with that rigorous methodology, Fund 1, we made about 24 investments. Fund just hit 4 years old. We've already had 2 or 3 shutdowns. Now, that's a lot less than venture in general, but it does not matter how picky you are. You're taking absolute risk. One side of the coin is wow. The other side of the coin is you lose all your money. It happens. You got to be comfortable with that.
Makes sense. Great insights. Tell us about AI. We're reading about it everywhere. We're using it seemingly everywhere. From the investor's lens, how are you thinking about it?
Well, in 2024, I made 3 investments. All were AI companies, explicitly AI companies. 2025, I actually only made 2 investments. One was a company that's a wildfire fighting robot called Wildfire Robotics. The other was in another fund, a defense tech and dual use fund with a friend of mine, Joe Musselman, who I really like and thinks does a great job. And I'd already invested a smaller amount, and I increased my stake in that for us. I do like to cross-pollinate. We have the right to invest about 10% of the fund in other funds. I like to invest in feeders and people I think can, go in earlier than me or be a connection or co-investors. So
that's kind of like your go-to-market, we could say.
Look, the network I have of 300 plus VCs is a great set of deal flow leads for me. But at the same time, I've funded probably 180 companies over the last 18 years. Those folks are also great leads. And I've got a corporate group called the Venture Corporate Innovation Alliance. That's another 250 people. You look everywhere. You got to kiss every frog and look under every rock. It's a journey of just nonstop questing. Like this week is medium busy, but not busy enough. And I was like, where can I go? Where can I go to find more? Maybe I should just go hang out on Stanford campus in the coffee shops. It's just, how do I find more founders to have more conversations, to find that golden dragon opportunity? Unicorns to me aren't big enough. So I'm also a D&D-er. You can't see all my D&D stuff on the shelf behind me, but it's there. And one of my entrepreneurs actually gave me a golden dragon. Unicorns in D&D are uncommon, but golden dragons are rare. I think there's 1.
Got it.
So that's more my interest. Anyway, it's, look, this is a wonderful job. It keeps your brain alive. You just meet phenomenal people. Even in the pitches you don't fund, you learn things. And, I love entrepreneurship. I have nothing in my life except entrepreneurship and my family. And I do play Call of Duty and Arc Raiders with founders and LPs and stuff. So I've got, that's my only vent.
Yeah. Where are we in the AI cycles or, cycle? And how do we think about the space as users of it, but also as potential investors?
It's a long way to go. Look, the thing that I think, here's where we are in terms of the cycle. And it's just like the cycle I lived through during the bubble of the web. I'll give you an example of this. I'll use a story. One of my founders, who's currently running an AI company worth about $4 billion that I invested in earlier, called me and he said, "Oh my God, Ben, these people just all want to work with us." And he was telling me a story of one person he said no to because they were too small. And they're like, "We'll pay whatever we need to." And I was like, "Okay, wait, let me just tell you how this is going to work." And this is where we are. In the beginning of something exciting like the web, first, people don't understand it, don't care. Then it gets so much attention that boards and CEOs and shareholders are like, are we covering ourselves here? This is an existential risk. We've got to work on this. And so all of a sudden, people are like, I got to get this done. They'll pay any amount of money to buy things they don't understand to use for their businesses. Then, a year or two later, show me the money. Because the same boards and CEOs that said, you've got to do this are like, wait a minute, we spent how much? What
Give
did
me
we
some
get?
ROI.
Yeah, show me the ROI. We're at that point right now. What happens is that's when the great shakeout occurs. This is classic venture. The reason that 65% of all venture dollars last year went into AI is because the companies that work will be some of the biggest companies in the world. And so you can afford to pay a couple billion if you end up with something worth potentially a couple of trillion. But going back to my original point, the only way you can get that sort of upside is to take absolute risk on the downside. Whether you paid $3 million valuation for a company or $3 billion valuation for a company in venture, when it doesn't work, you can still lose all your money. So the theory remains the same. If you do this from first principles, it makes no difference. Billions, millions, tens of millions, hundreds of millions. The thing is, do you get into the one that works? Fortunately, there'll be more than one. But we will see a shakeout. It'll be a bloodbath. And a lot of pundits will say, oh my God, look at this, these stupid VCs. They put $100 billion into these companies that went bankrupt. And they will ignore the fact that when Anthropic and OpenAI and these companies go public, they will be worth many times more than all the venture investments made in AI to date. Now, as an individual, I'm not sure I'd want to play this game because, give you another story. A friend of mine, I had funded this one company. I introduced it. One of my main jobs is to help entrepreneurs raise their next round. So I was helping this entrepreneur raise, I think it was his Series B, introduced him to this VC. VC called me over the weekend. Love this company, Ben, but they want like X, whatever dollars. It's 50 times revenue.
The company raised some money. Now they want to raise some more money.
Exactly. I funded them and others did. I introduced them to their next round, the Series B. And the guy's like, they want 50 times revenue or something. It's crazy. I'm like, Brian, I'm not going to pretend this price is rational. But here's the thing. It's not going to change. The entrepreneur has needs he will not move away from. You can either overpay today or you can overpay tomorrow. So that company got funded at $55 million and later sold for $1 billion. I'm sure he's just fine. Because the best entrepreneurs are always greedy for ownership, do not like dilution, and are very insistent on getting exceptionally high prices. But over time, as long as they continue that and deliver and succeed, Halsey Minor said this once with CNET fame for those folks that remember those days. He raised like $100 million and like a couple months later, he's going to raise another 100 more. And I was asking like, oh my God, how can you do that? And his response was, I can hit a wall going 50 miles an hour, 100 miles an hour, or 500 miles an hour. I'm dead either way. But if I don't hit that wall, I win a lot bigger at 500 miles an hour or something to that effect. So these companies burn a lot of money. They get very big. And when they win, it's awesome. And when they die, it's sad. But at the end of the day, the economics prove out in the same way they've always proved out for venture capital.
This episode of Beyond the Shelf is brought to you by It's Rapid. It's Rapid is the platform Pepsi, Mondelez, Instacart, and hundreds of other leading brands and retailers use to build personalized content at scale. Whether that's images, videos, or product descriptions for their product detail pages, shoppable videos or banners for their digital ad campaigns, or sell sheets for sales enablement, brands that use It's Rapid are able to produce high-quality, on-brand content on average more than 80% faster than category competitors. To find out more, please visit itsrapid.ai.
Tell us about some categories. You mentioned some companies like Anthropic, OpenAI, and so on. What are you looking at? What are you seeing in the market that's interesting?
I look at everything. Look, last year, the only thing I funded was a wildfire fighting robot. It wasn't like I was out there looking for a wildfire fighting robot, but Wildfire Robotics out of Canada was just smart people doing something that was really needed in the world. And I think, an industry that hasn't changed its technology in 100 years, I wouldn't say every city in the world needs firefighting robot technology, but I'd say many, many, many do. And so huge opportunity. I do need enormous opportunities at scale.
And that company, for example, they're using AI in some way. as part of
Oh,
their.
so it's another fair point. I'm not necessarily just looking at AI companies, but every company is thinking about how to ingest AI. I have a company out of New York called Vendalux. Vendalux is basically a software system, sort of like Salesforce for real world marketing, for people that need to take their companies to trade shows and other things to identify where they should go, who they should meet, et cetera. And they discovered that when people use their software well, they got lots of meetings at those trade shows and they renewed their contract. But when they didn't use the software effectively, they didn't get meetings and didn't renew. So they used an AI system and built out an agent to make the appointments for their customers. So now when their customer buys their software, the software does the work for them and they get more meetings. And when, by the way, we're talking about $1 trillion opportunity, just to give you a spec. Trade shows have exploded and, every conference has exploded ever since COVID, as I suspected they would. That was part of the thesis of making the investment. And so, this way people can be much more efficient. I don't know if you go to CES or any of these things, but you go to CES, people are spending millions of dollars on their booths, massive amounts on sponsorship. Getting more meetings while you're there is critical. And this is a very effective way to do it. So Vendalex has been a real star, but it started as a traditional SaaS company and then embedded AI. So every company has to figure out how to use AI. AI might reduce costs. AI might increase revenue. Maybe it reduces headcount in terms of your need over time, which is critical for startups because they can only hire so many people. You're not talking about IBM where you have pretty much unlimited budget for hiring, I would assume. You're talking about a startup that has 12 people, going to 50 people, going to 200 people. If you can do the work with 200 people, with 500 people of a larger company, that helps a lot. A startup's only weapon of advantage against a bigger company is speed. And if AI can help with that and make you leaner, awesome.
Now let's pivot over to the customer side. A lot of our listeners here on Beyond the Shelf are at brands, at retailers, places like that. Any words of wisdom, rules of the road as they're thinking about bringing in AI? Obviously, they're all really excited about it, but to your earlier point, they also want to have something that'll deliver ROI.
So I think in these early stages, you let your teams, and if you're not the one with the purse strings, you go to your execs and you ask them for this. Try anything within reason. I'm not saying dedicate $10 million each to 10 efforts. I'm saying you can take a rational amount of money and let people in each functional group of the organization try whatever they want with AI and report back to what worked and why. Trust but verify, record, measure.
Yeah.
And then you'll figure out what works. If you try to figure out in advance through an enormous amount of research, oh my God, we think the leader in this category is company X. All you did was spend a huge amount of time thinking instead of doing.
Yeah.
Let your people buy a month, 3 months, a pilot, a single user license, whatever. Do it as an individual. Most of these companies, all you do is, and just do things with it.
Yeah.
Okay. Then you'll know. You could try 100 products. Maybe 2 will work. Maybe 10 will work. Any product that makes your business better is worth having. Now, look, it might not be inexpensive. You might have a product that the cheapest price you can get in is $60,000 or $100,000, even $1 million. So you have to have a realistic view of it might take a little bit more to spend that $1 million, but it depends on your size. If you're an enormous company, really, it matters to spend $1 million to find out if that's the thing that's going to impact your business in a material way. I have a company called Orchestro, which does AI-based procurement optimization to help the organization buy things better. They can save 20+% for companies that are doing RFPs for tens, if not hundreds of millions of dollars. What would it be worth to do a POC with them? I mean, we've got companies that would come in with $20 million and we save you 20%. That's $4 million. Spend $500,000, figure out if it works. If it does, do a real contract. So I do think larger companies tend to, remember my point that the only advantage a startup has against a big company is speed? Well, there are places where big companies can have speed. Empowering individuals to have a certain amount of money. I remember long ago, I was really impressed. I think it was Merck. They did a pilot with one of my AI companies. Literally, I found an AI company 14 years ago. And the way they did it was that each manager was allowed to spend, I think, up to $1 million each on up to 3 pilots a year. And so that was the way it worked. And it was enormously valuable to both parties. So, trying to research your way into this stuff.
Not going to work.
Yeah. I mean, I have friends at consulting firms, but hiring consultants tell you what to do. Just flip and do it. Do it, try it, see. Okay. Nothing proves anything better than the actual results. And it is, often a lot less than some of the professional consultants on their own.
I think we found the title for the episode right there. I love it. Just do more experimentation, use it, see what happens, and then you can really figure out what's gonna work. Such great insights. Ben, I've got the rapid rundown for you. A few fast-paced questions. Your quick thoughts. First off, one e-commerce company or product or technology that is positioned particularly well right now.
Well, if you were going to say, so like, there's a lot of things within that. So as an example, I'm not generally a big fan, even though I built an e-commerce business, I don't see a lot of venture scale opportunities in e-commerce. However, of the web-born brands, companies that were created online, that are just online, that are just ETC, right here, Warby Parker is one that I'm a fan of. I think they've found a product where the quality they can provide at a certain price is dramatically better in price than the quality you can buy from similar, just because of the nature of the semi-monopolistic economics of eyewear. The thing is that right now, companies that are doing specific vertical applications of AI, that's enormously valuable, more on the traditional software services side. But I only have two types of investments in my world: startup investments, absolute risk, and the S&P or some bonds. So I very seldom look. Although I'll tell you this: after COVID, when Zoom tanked because some people canceled, I bought up a bunch of shares. I'm like, what, are you kidding? It's like when Netflix tanked after COVID because they had I'm like, you thought this would continue?
Yeah.
Wow.
Right.
Anyway, so I should have held those longer. I sold them at a profit, but I should have kept them forever. But anyway, it's tough to do the Buffett model all the time. I do it as a startup investor. I buy and hold forever. As a public markets investor, I get nervous.
Speaking of startups, a mistake that you see founders making over and over that you wish you could guide them on.
Well, there's more than one, but similar to the conversation we had about what companies can do, waiting too long to launch. So I spent 6 months doing research when I started my .com in 93. I learned more in 6 days of being live. Just do it. Get live. Try it. Jump in the water and swim. You throw a baby in the water, it'll learn to swim pretty quick. Same thing. Failure to launch is a huge problem. Letting perfect be the enemy of good enough. Get it live. Get going. The other thing is that sometimes engineering-led startups where the CEO is an engineer hold on to the sales reins for too long. It's not what they're good at. But smart people like to believe they can do anything well. I certainly suffer from that. And so they do it for too long. And eventually they realize they have to hire somebody who's super expensive, makes more money than they do, but can be world-changing for the company. They do need to bring in that professional sales work, but really getting live sooner. The other thing is be more frugal. The best entrepreneurs are frugal, both in how they spend and how they protect their equity. Like I say, just do it, try things, but don't bet the farm.
Yeah.
You don't put your company at risk. I'm reading John Malone's book right now. And he was talking about how one of his mentors said to him, always ask, what if not?
Yeah.
If you're wrong, the company better not die. But it's so inexpensive and easy to try digital things. Try. But fundamentally, look, my fund's called Tenacity. Never give up.
Ben, after a busy week of meeting entrepreneurs, looking at cool new capabilities in the market, how do you like to unwind?
I play Call of Duty, and now I've added Arc Raiders. Interestingly, Arc Raiders was introduced to me through an LP who I play Call of Duty with. I also played Call of Duty for a long time with my top CEO in the portfolio, but he never has any time anymore, which is fine. He took a company from about $2.2 million to $509 million of revenue annualized in 3 years. I don't want him playing Call of Duty.
Yeah, right.
But that's pretty much it. My wife and I put in a pickleball court in our backyard. I did it because I wanted to get rid of the grass. She did it because she likes pickleball. So I occasionally do that.
A win-win.
Yeah. It was hard to convince her to rip out that grass. California does not need grass. We live in a desert. I often do meetings in my fire pit over a glass of whiskey, like one. I'm not a big drinker, but one whiskey, one cigar. And that's nice. It's like my weekends, if somebody's here. I mean, when I say I have no other focus outside of entrepreneurship, it's my founders. It's people that can help my founders. All my friends are my founders or my LPs. Like my social network is the one that came with my family, meaning the kids have parents and friends and blah, blah, blah. But, I don't go to sports events or anything like that. I work out really hard. I do CrossFit. And it's nice to get a really intense workout in, particularly if you've got stress. because nothing like living heavy weights or just really exerting yourself to sort of purge some of that. If you ever get really frustrated, that's a great way to get rid of it. And I can get frustrated. You can't hit a pickleball hard enough to vent frustration, but you can, clean and jerk a bunch of weight enough times to get rid of almost any amount of frustration or anger.
Ben, thanks so much for taking the time to talk with me on Beyond the Shelf. If our listeners want to find you online, what's the best way for them to do that?
So a lot of my inbounds come through LinkedIn. Both, by the way, Tenacity doesn't have a website. It just has a LinkedIn page. Ben Narasin is on LinkedIn. I'm also on Twitter. I read every single LinkedIn email I get, just like I read every single Twitter DM. And now I will say this, if you're pitching me a business, read my profile. It's very simple structure. And if you don't follow it, I'm just going to send you back a picture of my profile with a big circle around the instructions I gave you that you obviously didn't read. So it's an easy catch. Just do the tiniest amount of research and you're good to go. Because I have on occasion found things through these I ran a site called Pitch Ben for a long time where people from anywhere in the world could pitch me an idea. They had a 1-minute time frame to pitch a video and I promised them a response. And I actually funded one company from that. So I am willing to work very hard and look in every possible nook and cranny to find the next deal. Feel free to send it on over.
Awesome. Ben Narasin, Tenacity Venture Capital. Tenacity, that's the name of the game. Thanks again.
Thank you. A lot of fun.
That's it for this week's episode of Beyond the Shelf. If you enjoy the show, be sure to like, subscribe, and leave us a review. It really helps us grow. And feel free to share us with your colleagues so they too can hear weekly perspectives from the brightest minds in e-commerce. You can also check us out on LinkedIn, where we post clips from each episode, share Dave's takes on breaking industry news, and much more. Beyond the Shelf is a production of It's Rapid. Our host is Dave Feinlieb, and our producer is Jake Musiker. Thanks for listening, and we'll see you next time on Beyond the Shelf.